The grocery industry is on the verge of a major shakeup. This potential transformation is poised to redefine the landscape of how we shop for our daily essentials. Two of the biggest names, Kroger and Albertsons, have announced plans to merge. This monumental decision has sent ripples through the industry, capturing the attention of both consumers and competitors. This deal would create a grocery behemoth, potentially changing the way Americans shop for food. The combined entity would boast an extensive network of stores, offering a vast array of products to millions of customers nationwide. The proposed merger has sparked intense debate, raising concerns about competition and potential price hikes. Critics argue that such a consolidation could lead to a monopoly, reducing the number of choices available to consumers. Regulators are closely scrutinizing the deal. They are tasked with ensuring that the merger does not violate antitrust laws and that it serves the public interest without stifling competition. The merger has also captured the attention of investors, industry experts, and consumers alike. Stock prices of both companies have fluctuated as the market reacts to the news, reflecting the high stakes involved. Everyone is eager to see how this massive consolidation will reshape the grocery landscape. Employees, suppliers, and customers are all watching closely, anticipating the changes that may come. The outcome of this merger will have far-reaching consequences. It could set a precedent for future mergers and acquisitions in the retail sector, influencing how other companies approach growth and competition. It could impact everything from the prices we pay at the checkout to the variety of products available on store shelves. Consumers are particularly concerned about how this merger will affect their wallets and shopping habits. The proposed merger is not without its critics. Many are vocal about their fears that the consolidation will lead to negative outcomes for both the market and consumers. Some argue that it will stifle competition. They believe that fewer players in the market will lead to less innovation and higher prices, ultimately hurting the consumer. They fear this will lead to higher prices and fewer choices for consumers. The reduction in competition could mean that shoppers have less variety and fewer options when it comes to their grocery needs. Others worry about the impact on jobs. The merger could result in redundancies, with overlapping roles being eliminated and some stores potentially closing down. They fear the merger could lead to store closures and layoffs. This would not only affect the employees, but also the communities that rely on these stores for their daily needs. These concerns are legitimate and deserve careful consideration. The potential downsides of the merger must be weighed against the possible benefits to ensure a fair outcome for all stakeholders. Despite the potential drawbacks, the merger also presents some potential benefits. A larger company could leverage economies of scale to operate more efficiently and pass on savings to consumers. A larger company could have more bargaining power with suppliers. This could result in better deals and lower costs for the company, which might be reflected in lower prices for consumers. This could lead to lower prices for consumers. The increased efficiency and bargaining power could translate into more affordable groceries for shoppers. A combined Kroger-Albertsons could also invest in new technologies and services. Innovations such as self-checkout machines, automated stocking, and advanced grocery apps could enhance the shopping experience. This could improve the shopping experience for customers. Enhanced services and a more streamlined operation could make grocery shopping more convenient and enjoyable. Only time will tell what the ultimate impact of the merger will be. As the process unfolds, all eyes will be on Kroger and Albertsons to see how they navigate this significant transition. The proposed Kroger-Albertsons merger is about more than just combining two grocery chains. It's a bold move that could reshape the entire retail landscape, setting a new standard for how grocery stores operate in the modern era. It represents a strategic move to compete in an increasingly complex and competitive industry. With the retail sector evolving rapidly, companies must innovate and adapt to stay relevant. This merger is a testament to that necessity. The retail landscape has been undergoing a dramatic transformation. Traditional brick-and-mortar stores are no longer the only option for consumers, who now have a plethora of choices at their fingertips thanks to technological advancements. The rise of online shopping, changing consumer preferences, and the emergence of new competitors have put immense pressure on traditional grocery stores. Consumers are looking for convenience, variety, and competitive pricing, which has forced retailers to rethink their strategies. Kroger and Albertsons are hoping to leverage their combined scale and resources to adapt to these challenges. By merging, they can pool their strengths, streamline operations, and offer a more comprehensive shopping experience to their customers. By joining forces, they aim to create a more efficient and resilient company. This merger is not just about survival, it's about thriving in a market that demands agility and innovation. This will allow them to better serve customers in a rapidly evolving market. Enhanced customer service, faster checkouts, and a more personalized shopping experience are just a few of the benefits that could arise from this merger. One of the key goals of the merger is to expand their customer base and geographic reach. By combining their networks, they can serve a broader audience and tap into new markets that were previously out of reach. Kroger has a strong presence in the Midwest and South, regions where it has built a loyal customer base over the years. These areas are crucial for the company's growth strategy. Albertsons has a significant footprint in the West and Northeast, regions that are equally important for its operations. The merger will allow both companies to benefit from each other's regional strengths. By combining their operations, the merged entity would have a truly national presence. This national reach is essential for competing with other major players in the industry. This would give them a competitive edge in an industry where scale is becoming increasingly important. Larger scale means better negotiating power with suppliers, more efficient logistics, and the ability to offer lower prices to consumers. Another goal is to enhance their digital capabilities and e-commerce offerings. In today's digital age, having a robust online presence is crucial for any retailer looking to stay competitive. The COVID-19 pandemic accelerated the shift towards online grocery shopping. Consumers who were once hesitant to shop online have now embraced it, making it a permanent part of their shopping habits. Both Kroger and Albertsons have been investing in their digital platforms. These investments are aimed at improving the online shopping experience, making it more seamless and user-friendly. However, they still lag behind online giants like Amazon in terms of market share. Amazon's dominance in the e-commerce space is a significant challenge that Kroger and Albertsons must address. By pooling their resources, they hope to create a more robust and competitive online grocery platform. This platform would not only enhance their market position, but also offer consumers a viable alternative to Amazon. This platform could rival Amazon's dominance in this growing segment. With the right strategy and execution, the Kroger-Albertsons merger could set a new benchmark for the retail industry, blending the best of both worlds, traditional and digital. The proposed Kroger-Albertsons merger has encountered a significant roadblock in the form of a lawsuit. This legal action has added a new layer of complexity to an already intricate and highly scrutinized merger process. Albertsons has filed a lawsuit against Kroger, alleging that the latter has breached its fiduciary duty. The core of the dispute revolves around financial obligations and the responsibilities that each company has towards its shareholders. The lawsuit centers around a special dividend that Albertsons had planned to pay its shareholders. This dividend was seen as a significant financial benefit for Albertsons shareholders, and its disruption has caused considerable concern. Albertsons argues that Kroger's actions have interfered with its ability to distribute this dividend. They claim that Kroger's interference is not only unwarranted, but also detrimental to their financial health. This has caused financial harm to the company. The inability to pay the dividend has led to a loss of investor confidence, which is reflected in the company's stock performance. This lawsuit adds another layer of complexity to the already intricate merger process. Mergers of this scale are always complicated, involving numerous legal, financial, and regulatory hurdles. It remains to be seen how this legal battle will unfold. The court's decision could set a precedent for how similar cases are handled in the future. The outcome of the lawsuit could have significant implications for the future of the merger. If Albertsons prevails, it could force Kroger to reconsider its approach to the merger. The lawsuit highlights the potential conflicts of interest that can arise in complex mergers and acquisitions. These conflicts can lead to prolonged legal battles and increased scrutiny from regulators. When two companies agree to merge, their respective boards of directors have a fiduciary duty to act in the best interests of their shareholders. This duty can sometimes lead to conflicting priorities and legal disputes. However, these interests may not always align. The boards must navigate these conflicts carefully to avoid legal repercussions and ensure the merger's success. This can lead to disputes and legal challenges, as we are seeing in the Kroger-Albertsons case. The legal battle between these two giants is a prime example of the complexities involved in corporate mergers. The lawsuit also raises questions about the level of scrutiny that regulators will apply to this merger. Regulatory bodies will be closely monitoring the situation to ensure that all legal and ethical standards are met. Regulators are likely to pay close attention to the allegations made in the lawsuit. They will be assessing whether the merger would harm competition or consumers, and whether the companies are acting in good faith. They will assess whether the merger would harm competition or consumers. The impact on market competition and consumer choice is a critical factor in the regulatory review process. The lawsuit could potentially strengthen the arguments of those who oppose the merger. Opponents may use the legal challenges to bolster their case against the merger, arguing that it would lead to unfair market practices. It could lead to a more thorough and lengthy regulatory review process. The added scrutiny could delay